Welcome to the growthink podcast. Today I have my guest, Jay Turo, CEO of GT Capital, GT Investment Management, growthink Consulting. Jay, welcome to the show.
Tim, great to be with you today.
Likewise. I'm really excited to talk about this topic of why business owners should consider alternative investments. I know you and I have been having a lot of conversations around alternatives, how the market environment is kind of shaping the perception of alternatives, where things may go in the upcoming election as it relates to alternatives a little more seriously. So I wanted to get your thought on why you felt business owners should consider alternative investments as part of an overall portfolio strategy.
Well, I think it starts with the wealthiest, the most prominent entrepreneurs, business owners in the world have made a pronounced move from public market investing to alternatives. And we'll talk about what alternatives are in a second. One of the big stats that jumps out is that in the last 5 years, we've seen the number of family offices, and a family office does a number of things, but a core one is evaluating different types of alternative investments for high net worth individuals and families, have grown from 1,500 family offices worldwide to over 5,000 today, and from managing about $1 trillion in assets to today managing over $6 trillion in assets. This is a byproduct of the significant change in financial markets to see traditional public market investing, so stocks, bonds, the New York Stock Exchange, the NASDAQ, the S&P, and then obviously foreign exchanges as well, become a smaller share of the overall capitalization of all different types of investments available in the world today. So just as a quick stat in that regard, 20 years ago, we had about 17,000 public companies traded on the U.S. exchanges. Today, that number, depending on how much you look at some of the OTC companies, is anywhere between 3,000 and 5,000. So we've seen a decrease in the number of public companies and, relatively speaking, a corresponding significant increase in the number of alternatives, which we can get into in a minute to describe what we mean when we say an alternative investment.
Those are really interesting stats here, going from 1,500 family offices to 5,000 and having 17,000 public companies now reduced down to about 3,000 to 5,000. These are pretty staggering stats when you put them together. Why the shift? Why the trend over the last 5+ years in this direction?
When it comes, let's take the question in two parts. So the first part is why the massive increase in family office and money's being directed in non-traditional ways. And that's driven very simply by the data over the past 5 years in terms of expected return has become quite definitive. That 5 years ago, 10 years ago, these aren't complex statistical analyses, but there was, we always use these numbers of, public market returns and the, from an equity standpoint, 9% long term. What were the returns on different categories of alternatives? Well, to the degree we look at alternatives, and one type of alternative, private equity, which is the one that is probably the most interesting to the high net worth business owner entrepreneur, is the data over the last 5 years has become quite definitive that the rate of return expectation is anywhere from 4 to 7 percentage points annually higher than is that for public company. There's a number of reasons for this. Traditional one has been liquidity premium, that you have private equity. By definition, you can't sell it tomorrow, although there is much more liquidity in private equity than there once was. And the second reason is variance, right? That these have traditionally been much riskier assets, tended to be smaller companies. That's certainly true, though, because of the evolution and the reduction in the number of public companies, the risk differential between a private equity investment and a public equity investment has declined. So that's within the realm of private equity. And I don't want to define private equity as the only type of alternative, but that's the one that has been probably driving more than anything else this move to this family office alternative investment model.
Yeah, that makes sense. When we speak about alternatives, there's naturally risk assessment, right? It's kind of like the first place that the mind goes of thinking, well, they're not publicly traded. Maybe they don't have that, gold stamp of the public company, but that doesn't mean they're not great alternatives out there. How does one even begin to consider assessing risk when it comes to, alternatives?
This is where, the best investors in the world, those that have the most sophistication, the most assets at risk, there's the return expectation. And then equally, or perhaps even more important, once there's a certain level of wealth attained, is hedging, is risk mitigation, depending upon various scenarios. And so what you have, has always been there, but now it's, the research has gotten at a whole nother level of sophistication, that hedging, taking into account different economic scenarios, different geopolitical scenarios, and how can we ensure that our principal is protected in all of the incredible unknowns that the modern world holds for us on a daily basis. And so this hedging context and being able to, as much as possible, have assets in a portfolio that perform in an uncorrelated manner is the holy grail. And more than ever, the ability to build a portfolio of uncorrelated assets is possible for smaller investors in a way that was maybe only accessible for those with full-time investment teams, big family offices, the Gates Foundation, big pools of money with really multi-dimensional investment teams. That a lot of that has come down and has become democratized and available to investors with less capital to put to work.
Yeah, and then what's your take on portfolio consolidation, specifically as it relates to business owners? So,
Yep.
Step back here. Most business owners have the large majority of their wealth tied up into their number one asset, the number one asset being their business. So they're often very not diversified because they have most of their wealth locked up inside of their own business. When we talk about why alternatives are important for the business owner, the entrepreneur, the everyday family-owned business all across the US, why should they also be considering diversifying in this arena?
Naturally, and it is absolutely fine and appropriate that a business owner is going to have the vast majority of their net worth in most circumstances in the value of their business. And there's significant benefits to that, to the degree that getting return on capital, the natural efficiency of putting capital to work in one's own business. So let's say that we have $100,000 to invest, as an example, that the ability to get a 20% return on that capital in some external investment, that's usually a pretty risky investment, right? Now you, Tim, with all of your experience operationally, from a marketing standpoint, with a good, well-run small to mid-sized business, getting a 20% return through a technology investment, through a marketing campaign on that 100,000 within the business is usually going to be a higher expected value than an external investment. So one of the beauties of having one's own business is the ability to put capital to work. Forget about 20%. I mean, if you were to, let's think about some of the tech implementations we've talked about with some of growthink's clients over the years. I mean, the expectations, we're getting 100% return. We do a $100,000 tech implementation and get the money back in a year, exactly. Right? It's not that high a hurdle. Mm-hmm. Because there's such an efficient, so that's the benefit of putting capital to work. That's got to be balanced, however, against concentration risk, right? That in addition to the business having usually wildly underestimated risk in terms of its going forward ability, based upon the health, the effectiveness of key personnel, right? Just one-off risks that any business is subject to, litigation, new competitors coming in, product obsolescence. Just, a lot of these businesses are right on the edge of like 5% decrease in their effectiveness across 3 or 4 variables. And all of a sudden, a business that before had a, 5% operating margin is now losing 5-10% a year. And they don't have the cash to bridge them. So there's massive concentration risk in an existing business. And that has to be balanced. And that's where saying to oneself, all right, and this is hard, Tim, as you know, because everybody has the best house in the block, right? So stepping back and saying, let me look at this business not as my baby. Let me just look at this as just another asset, another financial asset. And when you look at it that way, you say, man, I got to hedge. I got to figure out a way that if what are the circumstances that I can, if the business goes down, if whether it be things like very simple things, they're wildly out of everybody's control, like macroeconomic factors, right? Like, I
Inflation,
mean,
interest rates, and
inflation, interest rates, war. That just all of a sudden the stock market goes down 10,000 points. We go to a world that we're in the great financial crisis of 08, 09, the pandemic, and everybody's business is down 30, 40, 50, nothing you can do about it, right? So now those circumstances, my view of it is, hey man, the goal here isn't to be a martyr, all right? The goal here isn't like the goal is to win. While you can't completely protect yourself from all of those scenarios, you can lose less than the other guy. And in that situation, if everybody else is down 40%, let us only be down 10%. Okay. Or even better, everybody else is down 40%. Let's us be up. Let's be in a position that we can capture share from them. Okay. And in those scenarios, having a hedging strategy that if something happens in my business, that things go badly, that I have other things going on in my overall life and financial portfolio that go up, that just makes that's just classical portfolio construction that nobody would argue. That's just true. That's not like it's an opinion. It's
right.
just portfolio construction that people have been talking about for decades.
It just feels like sometimes we don't even look at our own business as an asset. It feels like a job sometimes as an entrepreneur.
Yeah.
You just go to work and you just do it, the grind every single day. You don't think this is my number one asset, right? Sometimes it's easy just to even overlook that point. And I think it's so important to hedge.
Yeah.
Saying because who saw COVID coming? It's like the greatest example. It was such a level setting example for all business owners. And now I think we can say, whoa, let's pump the brakes and see what we got to do here to survive another day. Sometimes that's what it takes. I want to turn the page here a little bit on the evolution of alternative assets. So we talked a little bit about what alternatives are and how to ensure you're de-risking a little bit with hedging and making sure you don't have consolidation, things of that nature. But they're kind of coming fast and hard at us, these alternatives. There's things like NFTs and crypto and fractionalized shares of art and all this crazy stuff is kind of coming at us. It's not just PE and it's not just the old standard secondaries. It's so many more. So what do you think the evolution of this alternative market looks like? Where's it heading?
Well, I think this is one of the, this is the golden age of investing. I mean, the ability for most of these categories have, again, only been accessible to those with very significant chunks of capital put to work. Okay. So let's look at a couple you just mentioned, fine art. I mean, fine art has been an asset class that has not only performed at a rate of return greater than public equity over the last 50 years, it's also one that has been somewhat uncorrelated in that its performance has not in any way been as it doesn't track the way that an Nvidia is going to track a Pfizer. And those, even though they're in different businesses, you're going to see very high correlation between the performance of those securities over time and the market as a whole. So fine art, but how would you get into fine art before? You'd buy fine art.
Exactly.
You gotta buy fine art. You gotta go out. You gotta go to whatever
Find
it is.
an art dealer, an art broker, or a guy in the back alley that's got something out of the van, a Monet or something.
And and in addition to like, there's a lot of know-how in that.
Yeah.
You gotta go. The old days, you have to go to an art auction. You gotta know what to buy. You gotta be careful of ridiculous amounts of fraud and corruption. And now it's a securitized asset that you could look at professional managers with track records that do all that work for you and make it available to you on a fractionalized basis for a management fee and a percentage share of the profits, in the same way that venture capital fund or private equity fund would be structured. So that's a tremendous opportunity. The whole world of crypto, that is in many ways just one of the great evolutions of finance, right? That there's a world that we can see 50 years, 10, 20 years from today. We move away from fiat currency. We move to the blockchain for the exchange of goods and services for some kind of medium of exchange. And that's something, again, let's look at it as modern gold, right? In the old days, that people still in this country, out there in Franklin, Tennessee, I'm sure there's folks out there, they got gold in the in the mason jars in the backyard. God bless them, right? And you know, crypto and blockchain I'm sorry, and Bitcoin, Ethereum. It's a way to hold an asset that protects against the vagaries of fiat currency. Does that mean it's for everybody? No, it's a very risky asset, but is it an asset that can hedge significantly against against currency risk? I think the evidence is pretty clear on that it is.
Yeah.
And so that's another example of something. Just those two right there. That as you start looking at portfolio construction for the business owner, those are the types of assets that should move opposite the performance of a traditional kind of just generic U.S. small and mid-sized business.
It seems like there's more opportunities to get involved with maybe even smaller offerings that previously weren't available. Things that kind of strike the heartstrings a little bit. And as owner operators, I've noticed a trend towards investing in some of these private equity companies that you can buy shares in as well. And as an operator, you can assess and analyze differently than, let's say, NVIDIA or Microsoft, right? I mean, they're just so big. It's like, if I own shares, I feel like I don't have much control. But if I'm investing into a business that I might have some industry knowledge about, and then I can jump on these shareholder calls and learn a little bit more about what's happening. That could be interesting. What's your take on investing in smaller private companies?
There's a couple parts to this question. And the first part is that earlier stage private equity is, as we mentioned a few moments ago, is the highest returning asset class in the marketplace. That when you start looking at and you start stripping out the traditional fees, such as management fees, carries that venture capital firms, private equity firms have traditionally charged to allow outside investors to participate with them in these types of investments, that there's some argument that those fees have been 20, 30, 40% of the entire return has been reverted to the managers of these funds, which is why a very high percentage of the richest people in the world are principals in hedge funds and private equity funds and venture capital funds. Okay, it's been one of the greatest businesses models of all time. Okay, now what's been great recently, like with many other things, there's been this democratization. There's been more efficiencies. A lot of those fees, there are ways to invest that are more that allow for dollars to be put to work without that huge fee overhang. Doing so directly into a private company, probably the riskiest form of investing, but if done correctly, can also be the highest expected value form of investing as well. So that's where, and again, that a lot of the opacity that's traditionally been involved there is still there. It still requires real professional know-how on how to. The big one being, which you and I could comment on extensively, is valuation, right? Like, what is the valuation? What is this? What is the ownership structure, the share structure? That if there is an exit, who's going to be the beneficiaries of those of the increase in value? So that's number one. Just that it is a very high performing asset class when done right. The second point you make is equally profound, and to the degree you're a successful business owner that's in a position to make investments in outside private companies. My God, I mean, who else is better to provide guidance than someone who's had success in business in general and entrepreneurship in general, and even more to the point, if you've had success in that particular industry, should be able to add some significant value that, in addition to increasing the likelihood of success of that investment, can be very personally rewarding. It can be a form of pay it forward to the next generation, which is very important. It's a very important part of, you and I, a couple old Catholic boys, right? I mean, as part of that is that to those who much is given, much is expected. If you've been a successful business owner, you've all this know-how, you should, as much as possible, make sure it doesn't end up in the grave with you, that you pass it on to the next generation.
Absolutely. So if someone's out there and they're considering, getting into the game, I mean, there's so many ways that someone can get into this game. There's Coinbase, there's Robinhood, there's equity crowdfunding. It just kind of goes down the list. What's wise, sage advice from Mr. Jay Turo on how to consider if this is right for you? Things that you could do to research. What would you look at?
let's quote some of the ancient philosophers here, Tim. The first place is to know thyself before going out there. Know thyself. There's multiple components of that. The first one is like actually understand how much you're worth. And what is your net worth? What is it? Which, by the way, most business owners don't know because they may have some sense of what their stock market investments are worth, what their real estate is worth. They don't know it as exactly as they think they do. Okay. And the big thing they don't really know is how much their business is worth. Huge, right? Like a lot of times,
all the
yeah,
time.
okay, it's a massive delta. All right. A lot of times they're wildly overestimating the value of their business. The business really worth zero because they got a job because the business isn't sellable. No one's going to pay them anything for it. And sometimes they are significantly underestimating the value of the business. They've just been at it for so long and they're just unaware there is a very, very active market of acquirers for small, mid-sized businesses that, have some attractive, attractive attributes, right? So know thyself, know how much the business is worth. That's number one. Okay. Second thing is like, let's have some heart to heart. Where you are, what are you doing this for? Where you at in life? You ain't gonna live forever. All right. If you're in your 50s or 60s, I mean,
Yeah.
it gets to be business malpractice if you're not thinking about succession planning. I mean, you know more about this than I do. I mean, my God. I mean, if you're as soon as you're hitting these ages, I mean, if you don't have a succession plan in place, by the time the succession is forced upon you, it's usually way too late to do anything about it.
Yep. And that's most often the case. Or the business needs to unwind. But knowing your life stage, I agree, absolutely critical because you'll have different risk tolerances as well.
Which is the huge third issue is that, risk, anybody that is a really serious and successful investor, they've done a lot of, they really understand risk in all its, it's in all its components. I mean, and again, that business owner is usually taking, business owners are interesting because, they do have this small town conservatism and frugality, and it's a key factor that makes them successful, right? The old Sam Walton, worth
I was
billions of dollars. Yeah,
J. Paul Getty's book recently, How to Get Rich, or something like that, and he's talking about frugality. And
yeah,
this is written in like the 50s, maybe,
yeah.
maybe even much earlier.
This is where the schizophrenia. There's that, man. If they really knew how much risk they were actually taking, they have this illusion of control, right? So they therefore, well, I'm running the business, I'm in control of it. Their risk profile is there's a huge gap between what they think their risks are and what they really are. And a lot of times these alternatives, by getting into a position to invest in them, while on the surface may look like, hey, I need to take more risk with what I'm doing. Actually, the idea is to diversify and hedge and de-risk. So that's a huge component of it. Now, the third piece I'll say it becomes philosophical is getting down to, what are you doing with your profession? What are you trying to accomplish here? And I always use the expression that in all of us, but especially in the business owner, there is usually these desires, both complementary and competing desires for freedom and security.
Oh, yeah.
Freedom, security, right? And so, having, really coming to grips with that. What does freedom mean to you? What does security mean to you? And when you start having those conversations, it's a heart to heart, right? It's a psychotherapeutic exercise, right? And that when you get through that, it opens up a lot of insight into what you should be doing with your business.
And I would say that's probably one of the more existential conversations we have with clients on a daily basis. It's the one thing that sometimes they just need someone to open up that door for them. And the second you open that door, it's like, it's almost like they're waiting for someone to ask them and waiting for someone to open up this conversation. And I would say if you're out there in the audience listening, call us, send us an email. We're more than happy to have that conversation with you because it's the starting point for anything and everything you're going to do in your investing life. It's the starting point for how you're going to exit your company successfully. It's the starting point for what you're going to pass down generationally. You have to have the conversation, albeit uncomfortable in most cases. It's a must. Jay, what would be your parting thoughts here as it relates to the topic of alternative investments and why business owners should consider this?
Not going to live forever. You wouldn't. The frugality that makes most business owners successful, that the other side of it is that most business owners that we encounter are sub-optimizing their approach to the management of the value of their business and everything else in their financial portfolios to the tune of literally millions of dollars. And so if on one hand you would be frugal and not expense millions of dollars without being extremely vigilant and making sure that it was done responsibly, in the same way, to the degree you're leaving millions of dollars on the table in opportunity cost and lost investment return and unnecessary risk, it's actually a sin. It's a sin, Tim.
There's no better way to end a podcast. All right. Well, if you've been following along, please comment, like, subscribe, share, tell your friends, contact us. We'll put our information down below. Thanks, Jay.
Tim, thank you.